Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of even the most complicated corporate filings. But today we've got a really interesting one, a SPAC that is merging with an insurance broker in Hong Kong. This filing details a proposed business combination, a plan to bring HCYC Group Company Limited to the public markets through AlphaTime Acquisition Corp. So what does this filing actually tell us about this deal, and importantly about the companies involved? Let's dive in. This document is essentially a registration statement, a prospectus, and a proxy statement all rolled into one. It is HCYC Holding Company that will become the new public entity, and AlphaTime Acquisition Corp. Is the SPAC they're planning a multi-step merger that involves several shell companies created for legal and tax reasons. Essentially, AlphaTime is merging with one of HCYC's shell companies, and then HCYC itself is merging into another shell company, all to end up as a subsidiary of a new public holding company that will be listed on NASDAQ, likely under the ticker HCYC. The deal is structured with a primary goal of legal and accounting reasons, and importantly for us, tax considerations to make the exchange of shares tax-free for shareholders. This is a common strategy in SPAC deals, especially when dealing with international entities. AlphaTime shareholders are being asked to vote on approving this business combination. That means they need to agree to the merger agreement and the plan of merger. There is also a proposal to adjourn the meeting if necessary to get enough votes, which is pretty standard. Scroll, what is HCYC? So who is HCYC? Well, this company operates out of Hong Kong, and through its subsidiary HCYC Wealth Management Asia Company Limited, it is an intermediary insurance brokerage company. They provide services like insurance consulting and product sourcing, acting as a middleman between insurance companies and customers. They do not underwrite risk themselves, which is important to note. Now let's get to the juicy part, the financials. Looking at HCYC's balance sheet as of the 31st of March 2025 compared to the 31st of March 2024, we see their cash has decreased from over 800,000 to around 523,000. Total liabilities, however, have significantly increased from about 1.16 million to 2 million. This has led to a drop in total shareholders' equity from over 200,000 to a deficit of almost 581,000. This is not a great sign. The company appears to be burning through cash, and its liabilities are growing faster than its assets. On the income statement for the year ending the 31st of March 2025, HCYC reported a loss from operations of almost 780,000, a far cry from the slight profit of about 30,000 reported in the prior year. Their net loss also grew substantially from a small loss of 18,000 to nearly 793,000. This indicates a significant deterioration in their operating performance in their latest fiscal year. HCYC's management attributes some of this to an economic slowdown in mainland China and the instability of currencies which hit their client demand. They also mention a decrease in policies facilitated from over 1,100 to 392. This is a concerning trend for a company focusing on growth. They are trying to offset this by increasing the average premium of policies sold, which rose from about 11,800 to over 13,200. It is a start, but not enough to overcome the drop in volume. Scroll risk factors, risks related to H60 risk factors. Now for the risks. HCYC faces significant customer concentration, with two partnered insurance providers accounting for over 90% of their revenue and receivables in 2025. If these partners leave or reduce their business, it would be devastating. They also admit to not having formal written agreements with most of their strategic partners, which is a major red flag. What if these informal arrangements fall apart? This could seriously impact their ability to operate. Operating in Hong Kong means dealing with China's complex and evolving laws. They acknowledge that the Chinese government could exert significant oversight and even intervene in their operations. This could lead to material changes in operations or even cause the company's value to plummet. This is a huge risk that investors need to consider. AlphaTime, on the other hand, is a SPAC. They haven't generated any operating revenues yet, and their main activity has been organizational and preparing for this business combination. Their liquidity situation is also precarious as of the 30th of June 2025. Their cash balance is only about $1,300, and they have a working capital deficit of almost $3.9 million. They are heavily reliant on funds in their trust account, which are meant for the business combination. The total assets in the trust account have dwindled significantly from over $74 million at the end of 2023 to about $15.8 million by mid-2025. This reflects a considerable number of shareholders exercising their redemption rights, which is eating into the capital available for the combined company. Scroll what vote is required to approve the proposals presented at the Extraordinary General Meeting Qing. To get this deal done, AlphaTime shareholders need to approve it. The business combination proposal needs a simple majority vote, while the initial mergers proposal needs a 2/3 supermajority. That is a high bar, especially with shareholders redeeming their shares. The sponsor and insiders have agreed to vote in favor, and their shares represent about 28.6% of the outstanding shares. This means they still need significant support from public shareholders. Scroll interests of AlphaTime directors and officers in the business combination. Seek it is worth noting that AlphaTime's directors and officers have their own interests in this deal. The sponsor, for example, bought their initial shares at a very low price expecting a huge payoff if the deal goes through. They've also loaned money to AlphaTime which will be repaid. This could create a conflict of interest where they might be more inclined to close a deal, even if it is not the absolute best for public shareholders. Scroll beneficial ownership of Pubco securities following the business combination Chi. Looking at the ownership breakdown after the merger, HCYC shareholders are set to own a majority of the company, around 63% in the no redemption scenario, and even more if redemptions occur. AlphaTime's public shareholders will be significantly diluted, owning only around 9% in the no redemption scenario, and even less if redemptions are high. The sponsor will hold about 18 to 19%. This means HCYC, along with its beneficial owner Ms. Yamong Ding, will essentially control the combined entity. Scroll an audited pro forma condensed combined statement of operations for the year ended the 31st of March 2025 to Cindy Q. The pro forma financials show a combined company still operating at a loss. Even in the no redemption scenario, the net loss is over $2 million. This isn't surprising given HCYC's own performance issues, but it highlights the challenges ahead for the combined entity. Scroll analysis seeks, so what is the story here? Well, AlphaTime. The SPAC is in a tough spot with declining cash and significant shareholder redemptions. HCYC is showing a deteriorating financial performance with increasing losses and liabilities. The deal structure seems complex, and the business model relies heavily on relatively informal partnerships and referrals. The shareholder dilution is substantial for AlphaTime's original investors. While HCYC hopes to rebound and capitalize on market growth, the risks related to customer concentration, regulatory changes in China, and the overall economic climate in Hong Kong are significant. For investors, this looks like a very high-risk proposition. The company is burning cash, its revenue is declining, and its structure is complex. It'd be wise to look very closely at the redemption rates and the future cash flow generation of HCYC before even considering an investment. Alright, that is our breakdown of this XC filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.